Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then. TS Harihar of HRBV Client Solution, Senthil Manikandan of Newberry Capital, and independent investment advisor Vivek Mavani join me on the show. Thank you to all for joining me on the show. Today on Hot Money, we'll discuss the sugar sector. It's been up and running over the past two trading sessions. We'll ask about the PSU stock, the non-banking PSU, which is the top buy or even a short call that our guests believe. We'll talk about JSPL and the restructuring exercise that they have recently announced, and consumer stocks. So we'll ask them which is the top pick among all the consumer durables. So those are the stocks that we'll be discussing on Hot Money today. But let's first start with the sugar pack. Most of the sugar stocks are doing extremely well in trade. Most of them are trading on 20% upper circuit, carrying on from what they happened on Friday post the government indicating that ethanol prices will also be increased. That actually benefits a lot of sugar producers. So what's the way ahead after the big 20, 30, 40% rally that we've seen across the stocks? Is it still a good time to buy sugar stocks, or will you avoid at this point of time? And what's the outlook for the sugar sector? We'll ask our guests. So Hari, I'll start with you. The news is out now. Most of the counters have reacted. The important thing is that most of the counters have fallen significantly from the recent highs. So that's why we're asking, is this news as important? Should sugar stocks, even after moving 20-30%, still be accumulated, or will you avoid?
See, even after the bounce in the last 2 days, I think most sugar stocks are way below their the peaks that they touched about, I think, 8 to 9 months back. I think the big worry for sugar stocks has been the glut of supply in the market, because I think the latest year, if you look at the October-September sugar cycle, I think the production was about 35.5 million tons, so which is actually a record, and that was anyway going to put pressure on the prices. Now that I think ethanol blending has been permitted, there are two things about it. Number one, I think there is a 25% hike in the price. Secondly, I think originally only molasses were permitted for ethanol. Now I think even the sugarcane juice is being permitted for ethanol. So I think there are two benefits as far as the announcement is concerned. And I would believe that if that 25% is able to increase the direction of sugar towards ethanol, at least the price of sugar in the market will start going up. So I think to that extent, I would believe that's positive. And we like Balrampur Chini. I think that's a good stock probably to accumulate in this particular sector.
Okay. Any reason that you prefer Balrampur Chini over the others?
No, most in fact, Balrampur Chini has typically been the most, I would say, sensitive to changes in sugar prices. And we believe that this is a stock which is going to benefit substantially once the sugar prices start moving up. So it also corrected sharply from the peak. And I think from lower levels, it's the one stock that looks set to bounce the most.
Okay, so Balrampur Chini is the one is down 45% on a 12-month basis, but for the last 3 months, because of the move that we've seen over the past few days, it's up 30% in the past few trading sessions. But Senthil, do you agree? Should sugar stocks be accumulated at this point of time? How do you read into this entire news that has come out?
So basically, I'm not fond of the entire sector itself.
Okay.
Because if you see, around 70% of the sugar production happens in Maharashtra and UP, and both these states sends around 130 members to the Lok Sabha. So it's heavily political in nature, and if you look at the government wants a lower prices for the consumers. At the same time, they want higher cane prices for the farmers. So which industry which is producing sugar has been the much impacted in this scenario. So as such, the recent measures by the government is specifically on the ethanol policy. I think it's good because in the coming sugar year, I think the production is expected around 30% higher than the last year. So last year we did around 26 million tons. So this extra production will go into for the ethanol production. So I think it has negate somewhat of the sugar glut, which will keep the prices steady for the government. The election year coming, they want to balance the consumers and the farmers. So I think this is a good time to exit the sugar stocks, those who are holding it. Okay,
so you're saying whoever had bought it should exit at this point of time.
Yes.
And you won't buy any of the sugar stocks at this point of time.
No,
you think it's priced in because of this 30%, 40% move that has come in?
Yes, I think so. Sentimentally, I think it has been priced in. Because if you look at the price increase in the ethanol, 25% price increase majorly for the ethanol produced from the sugar cane juice. Basically, if you look at the current production is majorly from the kind of the C and B cane molasses. So I think the sugar companies has to put in new machinery to produce ethanol from the cane itself. So I think the current price increase of around 30-40% is like sentimentally they have factored in majority of positives.
No, but as he pointed out, there are two benefits of it. First of all, because of ethanol becoming now more profitable, there will be capacity shift from sugar to ethanol, and at the same time, because of this shift, sugar production will go down, and as you pointed out, prices will remain stable. So fundamentally, there is a change. So don't you think that that could be a big trigger for sugar? Because if you take from the lifetime high, the stocks are still down 50, 60, 70% from that level.
So fundamentally for this scenario to hold, I think the oil prices has to be at around $80.
Okay.
For the ethanol to be economically to be mixed along with the crude. So I think this at current position, I think the ethanol sense makes sense. But what happens when the oil prices goes down? So we have to look at this scenario, and what happens if the sugar, now the production is in surplus, but what happens if the sugar surplus turns into a deficit? So these are the scenarios which you have to look at when we want to sense fundamentally this is the structure that is going to be remain for the next 3-4 years.
Okay, fair point. So we're getting all views, so two different views that we have come in. Vivek, what's your view? Which side would you say on this?
Well, I'm okay. The news that came last week relating to ethanol in terms of accelerated blending program as well as higher prices. So I think sentimentally they are positive, but when one looks at hardcore numbers, more than 70% of profits of integrated sugar companies, when I say integrated sugar companies, I mean those who produce sugar, cogeneration and ethanol and all of it. So 70% of the profits come from sugar, where they lose money, where they don't even recover cost of production given the high cane prices that are assured to the farmers and low wholesale prices because of the oversupply scenario that we have had over the last 2-3 years. So that scenario still doesn't change in terms of how it would have been better if the government had also announced export of some amount of surplus sugar in the system to the extent of maybe 3 to 5 million tons. But that unfortunately is not happening. Coming back to purely ethanol, yes, this 25% price increase straight percolates down to the bottom line, because there are obviously no or very little incremental cost to earn that 25% higher revenue. So to that extent, the losses from the sugar get sort of lowered because of higher ethanol profits. But that's about it in terms of what would be the benefit to the sugar companies. Taking 2 points from what Senthil mentioned, in terms of integrated sugar companies all these years, based on their policy that they could make ethanol out of molasses, and hence, and in sugar there is a straight formula that is 1 ton of sugar cane gives you X amount of sugar, so much of molasses, and the conversion to ethanol and so on and so forth, and that's how their capacities are calibrated. Now the government permits manufacturing ethanol straight from sugarcane juice, and sugar need not be manufactured at all. Then the question is, does the capacity is there enough capacity to process the entire additional sugarcane juice into ethanol? That becomes a question mark, and I think most companies probably will need recalibration there. So it's not something that will happen tomorrow, day after, or next month, or next quarter either. It'll take time. Okay. Just to recollect, Brazil has been doing that for the last almost 15 years in terms of manufacturing ethanol straight from cane sugar. Sugarcane juice. Sorry, sugarcane juice. India had a different process due to policy. So I think the spike because of this announcement in terms of positive sentiment is pretty much done with. I think it would be more of a trading bet, and that too 30-40% price increase over the last 2-3 days is, I think, more than enough. I'm willing to let it pass as an opportunity.
Okay, so that's the view that's coming in. One of our guests, Hari, believes that it's positive, and Balrampur Chini is his top pick, but the other two guests do believe that, if you have position, try to exit it or avoid sugar space at this point of time. So that's the complete 360-degree view on the sugar stocks and the rally that has happened now. The next stocks that we want to speak about is actually a sector. A lot of PSUs have started coming off, and I'm talking about the non-banking PSUs, be it the defense companies, be it the oil companies, be it the engineering companies. But of late, we've seen a little bit of traction that's come out in the counters like, you know, a BHEL or the oil marketing companies. What we are asking our guest is that, what's your view on the non-banking PSU? Tell us one stock where you would either go long or you would short. So we are giving them both the opportunities, but it has to be one PSU from which is a non-bank. So we'll start with you, Vivek. One PSU bank, tell us which that is, or is it on the long side or short side?
Yeah, so I'll pick Mahanagar Gas. It is now that British Gas has more or less exited, it is a PSU because the Gas Authority and the GAIL and Government of Maharashtra are joint promoters holding almost 45% or 43% holding in that. And of course, they have been controlling the management as well. So Mahanagar Gas is now a PSU. I'm bullish on it, have spoken on your channel earlier also. Basically, it's a city gas distribution company that operates in Mumbai city, Navi Mumbai, parts of Thane and Raigad district, supplies CNG and piped natural gas that comes into our homes, goes into commercial establishments and the manufacturing sector as a fuel. A huge upside in terms of conversion to natural gas from conventional fuels, liquid fuels or coal, whatever has been in use. As far as the industrial sector is concerned, as far as homes is concerned, it's a switch away from LPG. As far as auto is concerned, it's a switch away from petrol or diesel as far as the private vehicles or commercial vehicles are concerned. So in terms of growth opportunity, it's a sustainable growth opportunity over the next 3, 5, 10 years, year after year, volume growth from the existing geography, new licenses, potential to acquire new licenses, which also is an added trigger which could happen. A company which is debt free has almost 900 crores of surplus cash on the balance sheet as of March 2018, earns return on capital, return on equity of almost 20% and generates free cash flows. So all in all, a sustainable growth opportunity that I see in Mahanagar Gas at valuations which are not very expensive. I mean, just about 15 times current year earnings and perhaps about 13 times 1 year forward earnings. So there has been a sort of a negative sentiment on account of British Gas, which was also one of the co-promoters for the last almost 15 years, exiting the stock by multiple block deals, which is why the stock price has corrected sharply in the last few months. But from here, I see little downside. Okay,
that's the view, Mahanagar Gas. What about you, Senthil? Non-PSU stock, long or short?
Container Corporation.
Long or short?
Long.
Okay.
Basically, if you look at their Container Corp, especially in India, so they are the market leaders in the EXIM segment. And if you look at the infrastructure that they have built up in India, is around, they own around 76 plus terminals, and around out of this 46 are EXIM focused.
Okay.
So creating infrastructure of this kind could be difficult for any players to enter the market. And if you look at the current space, I think last 3-4 years, because of the crude drop, there was some market shift from the railways to the roads. But currently, I think now with the crude on the uptrend, there could be the competitiveness of the road players versus the railways could decrease. So I think obviously the market could shift towards railways, and the beneficiary could be the Concor. And if you look at their volume growth in the Q1 has been in double digit in the EXIM segment, which has been hovering around single digit in the last 3-4 years. So with rupee depreciation and the crude oil in the uptrend, I think the exports could see some uptrend. We have seen in the last number also. Plus competitiveness of roadways going down, I think the Concor could be the real beneficiary of this scenario. So at the currently the valuations, it's trading around 15 times EV to EBITDA. So on a strong balance sheet and with DFC coming in the next year, I think over the next 2 to 3 years, there would be a lot of volume growth also with DFC coming in.
Okay.
And the company is also developing multimodal logistics parks along the DFC. So this is also good for the company.
Okay. So Concor on the long side, MGL on the long side. Hari, which stock?
See, at a sectoral level, we are slightly negative on the oil space, especially considering that your petrol and diesel are already about 90 plus per liter, and I would believe that considering so many elections coming up, at some point the government is going to say enough is enough. So probably government will say 85 is the cutoff. Beyond that, anything the oil companies will take. So we are negative in the oil space as a whole. What we like is NTPC, and I think the way the power sector restructuring is happening and the urgency that the government is showing, we would believe that NTPC is likely to get a lot of very quality power capacity at very dirt cheap rates.
Okay.
So I think that would probably be a big factor in favor of NTPC. And I think at these prices, the stock is fairly, I would say, undervalued, and it leaves a good room for upside potential with this. So we have a target of about 220 plus, but I think excess power capacity at low rates is going to be the big trigger for NTPC.
Okay, so that's the view that's coming in on the non-banking PSU sector. MGL as well as Concor are the two counters that Vivek and Senthil have spoken about. NTPC on the long side is something that Hari likes, and on the short side he also indicated that he does not like oil marketing companies at this point of time. The next stock we want to discuss has been on a rally of late. Ever since Naveen Jindal spoke to Bloomberg and he gave his indication of the restructuring he wants to do in terms of how he wants to hive off his company into three different verticals. That will be the steel vertical, the power business, and the international operations, which will be the coal business. He wants to list the Oman business at a later stage. So he's given a lot of indication. The market seems to be liking it. It's already rallied from levels of 200 to 240. So substantial upside has already happened. But what we're asking is, will you bet on JSPL? It's already up 60% on a 12-month basis. Steel itself is doing well. So what's the bet? Is there more upside on JSPL? We'll ask, I guess. So Senthil, I'll start with you. It's rallied already, but still much lower than what it was trading earlier. Will you bet on this restructuring plan of JSPL?
So basically we're neutral to positive, majorly because of the valuation as much factored in, but going forward, what are the returns that the investor are going to get in the range of 15% kind of return. Basically because being in a commodity company, I think one has to invest at the bottom of the cycle when the companies are loss making, because now much of the uptrend in the steel prices plus the company's initiative of debt reduction has majorly factored in the prices. If you look at the current debt profile, it's around 42,000 crores and they've reduced it from the lines of 48,000 crores and going forward also they are planning a IPO for their Oman facility, so further debt reduction. Plus if you look at the EBITDA in FY18, they've done around 8,000, 9,000 crores of EBITDA. So EV to EBITDA basis, debt to EBITDA basis around 4 times. Still it's on the higher end, I could say. Majorly because the Angul facility has currently ramped up, plus they are majorly in the long product segment. Their other competitor is SAIL. So SAIL has also completed its capex expansion and it is also coming on stream. So I think many of the players in the steel sector, I think the valuations are mostly factored in. So going forward, the returns could be in the range of 15 to 17% kind of returns, and that is not enough for the risk that is only staking on the bets. Okay,
anything that you prefer in the steel segment? You said that you are neutral to positive. If someone has to take a bet, anything in the steel sector?
So I could bet on Jindal Stainless. Majorly because they are the market leaders in the stainless steel segment, and with a lot of opportunities coming in the metros and things like that, and the valuations, if you compare with the steel producers with the Jindal Stainless Steel, the valuation differential is around 20% discount they are trading. So I could prefer Jindal Stainless.
Okay, Jindal Stainless and neutral to positive on JSPL. Hari, your view on JSPL?
We are cautious. I agree to likes in what Senthil says. I think the SOTP concept that we keep hearing about, you separate your international, your power and your steel business. I think that's fine, but I would be very keen to see how they actually implement it, because if you look at the debt burden that JSPL runs, about 40,000 crores plus, and then you need to first monetize the assets and use the monetized assets to reduce the debt. So I think it's a long journey, and the kind of bounce that we have seen in the stock in the last probably few days after the announcement. I would believe that most of the short-term upsides are factored in. Even otherwise, I think steel as a whole, we have a slight degree of caution, because we believe that if the trade war kind of escalates the way it's been going on, I think one of the things to get hit would be Chinese demand and therefore steel demand. So we would be a little cautious on steel as a whole, and especially JSPL. I think till the time there is clarity on how they're going to monetize the assets, we wouldn't be too keen to touch the stock at this point of time.
Okay, so that's the view that's coming in. Vivek, do you have a view on? I believe that you don't have a view on metals, but do you have anything to say?
No. So again, as I mentioned, I don't really track the steel sector as closely to really give an informed opinion on JSPL. So I'll give it up. I'll avoid commenting at this point of time.
Okay, so that's the view that's coming in. I think the consensus view we're getting is a cautious view on the steel sector as such. Don't see too much potential upside in JSPL at this point of time. And the last sector or the stock we want to talk about is the consumer durable space. Most of the companies in this space, be it a Voltas or a Titan and all, they have rallied significantly. Especially, you know, the white goods that have rallied significantly. The top pick in the consumer durable space, that's what we are asking. And I'll start with you, Hari. Which is your top pick in the consumer durable space and why?
I think if we restrict to durables, I would say Havels would be my top pick. Also considering that Havels has corrected a little bit in the last few days, and you know, we believe that the way Havels has positioned itself in the electrical equipment space, and with the addition of Fedders, white goods, and I think air conditioning space, I think they virtually have a kind of a hold over the entire market. And you know, with GST and the gradual shift from unorganized to organized, I think players like Havels are going to be big beneficiaries. So we would believe that if you're looking at consumer durables, probably Havels should be the one stock we really like at this point.
Okay, any potential upside target that you see on Havels?
See, we have a 4-figure target. We believe eventually, probably over the next 1.5 years, the stock should get to over 1,000.
Okay, and what are the key trigger? Why Havels over the others? Is it only because of the positioning that they have across the segment?
No, I think not only positioning, even the penetration. If you look at Havels in the electrical goods space vis-a-vis other players, I think Havels is a much better penetration, probably a much better brand value, and also I think the willingness of dealers to sell Havels products a lot more compared to other products. So the reason I'm saying that is important is the moment the shift happens from unorganized to organized, the company that is which the dealers are more willing to push, I think those are the companies that are going to take off. So from that perspective, we like Havels quite a bit.
Okay, Havels is the first pick in the consumer durable space. What about you, Senthil?
So we like V-Guard.
Okay.
Basically because if you look at the company, they have in a transformation phase, moving from a south base to a national level player. Currently, the non-south market contributes around 35% of their sales. But if you look at the last 3-4 years, they have been substantially increasing their dealership in the north market. Okay. And if you look at the expansion has been in the range of 4x versus in the south they have expanded the dealer by around 2.5x. And if you look at the last 2 quarters, they have been brand building exercise also they have done. They have spent close to around 45 crores of rebranding themselves. So if you look at the major growth prospects will be coming from the non-south markets. And they have next 5 years they are buying a 50-50 mix between the south and the non-south. And the major growth for the profitability level will come from the margin expansion, because currently if you look at the southern markets are doing EBITDA margins of around 14%, while the non-south markets are doing it around 7%. So there is a 7 to 8% margin gap between the south and the non-south. So in the next 5 years, I think the margin gap would somewhat lessen. So that will result in a substantial growth at the bottom line level. So apart from that, the management quality is a proven management quality, plus they have a strong balance sheet. And even the product level, they are also expanding into kitchen appliances, plus their new product in the switchgear segment also done well in the last 2-3 quarters. So considering the product diversification plus the geographical diversification, I think we are quite positive on this.
Okay, so after Havels, it's V-Guard, and Vivek, what do you have for us?
I'll stick to Titan. We had discussed Titan last week, so at the cost of repetition into the consumer durable space, I find Titan as a sustainable long-term opportunity driven by regulation. I mean, GST squeezing out these small mom and pop jewelers and the market moving to organized branded with a Tata assurance in the name of Tanishq. The watches business too is picking up, and the eyewear business is now acquiring critical mass and will be profitable. And the size of the opportunity in the eyewear business is perhaps as large as what jewelry business is today, from a couple of 100 crores that they did last year. I think they did about 500 crores gross sales in the eyewear business. So in terms of a sustainable opportunity, all the building blocks in place, the management has guided for a 20% growth in the current year, but also guided a long-term target of 50,000 crores of sales by 2023. So that's just about 4.5 years from now. And a better product mix in all the segments, jewelry, watches and eyewear, will lead to little of margin expansion as well. A company with sustainable return on capital, return on equity in the range of 20-25% they've done in the past. They will likely continue to do that in future as well. Valuations at about 45 times current year seem okay, slightly rich, but on declines. I would have Titan on my buy list. A disclaimer, we already have an interest in Titan.
Okay, so that's the view that's coming in among the consumer durable. The last stock that we discussed is Titan. That is something that Vivek likes. But with that, it's a wrap on today's Hot Money. Hari, thank you so much for coming in. Senthil, Vivek, again, thank you for coming into the studio. Ask BQ comes up next. Stay tuned to Bloomberg Quint.